Good evening, folks. Thank you so much for making it. Sorry to keep you waiting. Welcome. Welcome to Library Mistakes. We are very fortunate this evening to have Russell Napier, who needs no introduction, the founder of the Library Mistakes and author of a couple of wonderful books that are both at the library. He'll be talking to us this evening about money printing in war and peace, which is unfortunately a more pertinent subject than we would like for it to be, but nonetheless better think about it now than later. We'll have questions afterwards, obviously, as always, and I think Russell probably will stick around for a bit after the official bit as well. So without further ado, I pass the floor to Russell.
Thank you, Boris. It's fantastic to be back. This is my third trip, and I just thought I'd fill you in the, Boris calls it a global movement, and I always thought that was a bit premature, but Boris, it is becoming a global movement. So thanks to Boris, we have Library Mistakes Lausanne, that's number 3, Edinburgh first, Pune in India second, Lausanne third, Singapore next year, but in November, Montreal. And in London, we will have a Library Mistakes next year. We have the money, very close to having a premises. So those are the ones that, I'm going to use the word now, will happen. And then we have about 3 or 4 others that might happen. So the obvious question is why? First of all, I can assure you that it's nothing to do with me running around the world telling people they need libraries and mistakes. This is people coming to us and saying to us, we need libraries of mistakes. So why? What's happened? Well, what happened is this. A lot of people, not me actually, I'm trained as a lawyer. Boris, what are you trained as again?
Bachelor's in Finance.
Finance. But there's a lot of people in the industry who've got bachelors in finance, masters in finance, economics, and what they were taught is really that this is a mathematical pursuit where it has a lot of maths in it and there's not really much more to it than some very complicated mathematics. And then they look out the window and they see Donald Trump or they see Xi Jinping and they say, what on earth is maths going to tell us about this? And then they realize that before economics was economics, it was something different. It was called political economy. That is what it was founded as. And as political economy, it wasn't just maths. And I'm not here to tell you maths is bad, maths is wrong. I'm saying maths is just part of it. What else was in political economy that is very difficult to put in your spreadsheet? Well, psychology, philosophy, sociology, politics. So the world is now saying, well, it was pretty stupid for us not to have that. So how do you get an education? I mean, do you really go and spend 3 years studying sociology, 3 years studying psychology, 3 years studying philosophy, 3 years studying? You read financial history. You read about the way the world has been as a guide to how it will be. Not to see patterns, but to understand mechanisms and to put human beings back into this equation where they had been taken out. So the analogy I like to give, because I live in Scotland, is whiskey. The Scots are very good at making whiskey, and it's a process of distillation where you throw lots of things away. Well, our job is to put them all back in again. And that is why we study financial history. So with that in mind, I'm going to talk about money creation in peace and war. That is backward-looking, but there will definitely be some forward-looking conclusions from this about what's going to happen in this world of money. I think you all have copies of this. It's got a rather dramatic title, Tax, Print, Borrow or Plunder. But that is really for those who are at war. That's not necessarily for those who are at peace. So the 3 tests of money, you'll all be familiar with them. And I just want to discuss them in the context of the new form of money we have coming along called crypto, which I'm not going to spend a lot of time on. But as we go through this, you can think where crypto might fit in this whole thing. So a medium of exchange, will you accept it as payment for good, service or asset? Well, I think Bitcoin, maybe not, but we are getting to a world where that will be true of stablecoin. So the Americans in particular have passed a thing called the Genius Act. I don't know who thought that up, obviously some genius, but anyway, they have a Genius Act, or someone who thinks they're a genius anyway. And what that stablecoin is effectively a money market fund linked to the blockchain. So it is as good as a money market fund. And as you probably know, I think it's very, very rare for any money market fund ever to break the buck, for the nominal value to go down. And that is what stablecoins are going to be. So they are acceptable as a medium of exchange, or are becoming acceptable as a medium of exchange. And other countries are now accelerating looking into this. The governor of the Bank of England, you may have seen just 3 days ago in the Financial Times, talked about stablecoins as something that can be useful. The Americans see it as a weapon as well against China, a way to lure capital out of countries that try to stop it from coming out, whether that be Venezuela or China. Americans have quite a long list of people who they'd like to see suffering from capital outflow. So medium of exchange, we all know what that is. A unit of account, can we price everything in the room in the medium? Well, I think you'll be able to do that with stablecoin, not with Bitcoin, because it moves up and down a lot. So it doesn't make it impossible to go out and buy a pint of beer with something that's moving 5 to 10% every day. Just makes it a bit difficult. So stablecoins will not be moving like that. They'll be linked to the value of US Treasury securities, or perhaps maybe British government securities as well. And a store of value. Well, the last one is peculiar, isn't it? Because it's the avowed intention of our central bankers to make sure that you lose 2% of the value of your currency every year. That is the target. So is it a store of value when their entire goal is to make sure that next year you've only got 98% of the purchasing power of the year before? Anyway, as a store of value, paper money has not been wonderful, but it serves, it works, and people accept it. So it passes all of the 3 tests. So with those 3 tests in mind, we're going to go through the history of money. So we need to begin with who makes money, and this is maybe the only bit of this talk that is important or must never be forgotten, because it is grossly misunderstood. Money is not made by the government, and money is not made by the central bank. Money is made by commercial banks. Now, when I say that, people tend to disbelieve me. So I wanted to read something from the Bank of England. Usually when the Bank of England say it, people don't disbelieve them. So in the modern economy, most money takes the form of bank deposits, but how those bank deposits are created is often misunderstood. The principal way is through commercial banks making loans. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, therefore creating new money. That's it. That's where money comes from. Now, if we look at sterling, for instance, it's 87% of all sterling created in history, i.e. the total amount outstanding, has been created by commercial bankers. 3% is in the form of notes, banknotes, which is created by the government, and the rest is balances or reserves created by the central bank. So the vast majority of all sterling has been created by commercial banks, which means, of course, that money is actually backed. You know, we often talk about fiat currency, and your banknote is not backed by anything. Let's see if I've got a proper banknote in my pocket. So here we have a 20 Swiss franc note. So it is unbacked. Well, maybe unless you include shares in Apple, which maybe be backing this, but let's leave that aside. But if I take it to the bank and put it in as a deposit, it becomes a liability of the bank. And of course, it's backed. It's backed by all the assets of the bank. And what are those assets of the bank? Well, they basically, let's take the big ones, loans, securities, which is usually debt securities, and reserves that it holds with the Swiss National Bank. There's other things, there's a bit of equity in there. There's some tangible assets, etc. But when this becomes a deposit, it's backed by those assets. So when we're looking at how much our money may or may not be worth, one of the things we also have to look at is the assets of the commercial banking system. I'm calling it banking system in Switzerland. Maybe you just call it bank system, do you? Because there's just the one. The Swiss franc is effectively backed by the assets of one bank, predominantly by one bank. So that's how most money in the world is made. Let's just sort of run through all the different types of money. So coins, you'll not be surprised to know what coins. This is one from Marcus Aurelius. Many of you will read the Meditations of Marcus Aurelius. If you haven't, you should read the Meditations of Marcus Aurelius, 160 AD. But the coins have been around since the 6th century AD or BC, and it's interesting that will probably be the first one to disappear. I'm sure many of you don't even see a coin anymore. It's quite possible to spend a whole year and never see a coin, that'll be the one that's disappearing. The interesting one is what we call ledger money. Now, ledger money does precede banknotes. So I want you to imagine that all of us in this room, we all know each other very well, and we all trade with each other. And some of us owe debts to some people. And so Boris owes me 50 Swiss francs. But it's just down on a piece of paper that he owes me 50 Swiss francs. But this gentleman knows Boris. So when it comes to me paying you, you think, I know Boris. Boris's credit is good. I assign what Boris owes me to you. No, that's money. We've just done a transaction. And that's the sort of money that was kind of hiding in the shadows for a long, long time, but is coming out of the shadows now. And it's credit. Credit is money. The difficulty with that is, unless you know Boris, you're not really going to do that because you don't know how good his credit is. But in small societies, that happened. Now, there's a pretty new book out by a man called Paolo Zanoni, looking at medieval Italy and losing some of the records of charities. One of the people who were a sort of clearing system for this were charities. So charities had a bigger scope than the people in this room. Were having some view on the credit worthiness of people, and they could match these credits off against each other. So long before there was a banknote, there was that form of money. It wasn't a coin at all. It was an important form of banknote, but particularly amongst merchants, which is why it really gets predominantly important up in Italy. So is that paper money? Well, not represented by a piece of paper, but represented on a piece of paper. The banknotes come along, and only after banknotes do we get bank deposits. And I'll talk about that. And now we have crypto, and that's it. That's your list of money. We're going to talk about each of them. So as I mentioned, I've got a little one here from 165 AD, but the first one was 6th century BC. Now this is mainly focused on America, because I originally did this presentation to the West Point Military Academy, so that's why it's focused on America. But America's interesting because America obviously becomes independent in 1782, Treaty of Paris, and then its money is worthless. It has destroyed the value of its money and it has to begin to build its money from scratch. So the first thing they do is they start using other people's money. And the type of money that is used there effectively is one of these. This is effectively a 1 ounce silver coin. And from 1515 to 1978, this was a global currency. So you'll hear it said that there's never been a global currency, but there has. And it was a 1 ounce silver coin. I have one which I've just bought this morning from 1851, one of the very first Swiss franc Confederation coins ever created. Because why was this a global currency? Because everybody knew it had 1 ounce or nearly 1 ounce of silver in it. So when America arrives as an independent nation with no money, it simply ends up using Spanish money. And a Spanish coin of that size is called an 8 real piece, also known by pirates as pieces of 8. And when they come, and they'll be having German money as well, thalers would have been circulating, and a few maybe still British crowns. So when it comes to creating their own money, this actually is a silver dollar. And guess what they do? They create a 1 ounce silver coin. And really, just about every country in the world did this, but the important thing, it was made of silver, and therefore it could trade absolutely anywhere in the world. In 1707, Scotland merges with England, and when they called in the currency in 1707 to remint it, called in the silver currency, less than half of it was Scottish. And you might think, well, that means most of it was English. No, most of it was not English. Most of it came from the continent of Europe, particularly the Netherlands. Scotland traded a lot with the Netherlands. A lot of it was Spanish. Because the thing about money is people accepted what they thought was good money. And what they thought was good money was 1 ounce silver coins. Now, you will probably know that as of today, this 1 ounce of silver is now worth, for the first time since 1979, I think, is worth $50. It's the first time we've got through $50 since 1979. So this is effectively $50 worth of purchasing power. That's quite a lot of purchasing power, but it's not an impossible purchasing power to buy a pint of beer with, to buy a meal with. So it wasn't gold that circulated as coins. We were on the gold standard and I'll come and explain that if you like. But gold didn't circulate in the economy. What is a 1 ounce? Everybody in this room will now know. What is a 1 ounce gold coin worth? $4,000 US. Well, try buying a pint of beer with a $4,000 US coin. Lots of beers. We can try later. Okay, I'll bring the coin. You bring the beers. So, for all intents and purposes, the world was definitely on a gold standard, but the sub thing that really circulated was this. Now, of course, there was lots of brass money going around as well, but that's silver currency. So, 1515 first minted in a country we now call the Czech Republic, and the last country to mint it was 1978, and I have one. This is the very last one, or the very last year anyway, minted in a country with a huge silver mine. Does anybody want to guess which country had a huge silver mine that kept going until 1978?
Mexico.
Mexico is the right answer. And of course, the reason that this couldn't go on anymore is where the price of silver was getting to in 1978. So the face value was a peso. Market value was much higher. So as soon as you printed these, there was a risk-free profit of just taking these and melting them down. So it had to end in 1978, but for that long period, this was a global currency circulating all around the world, to such an extent, actually, that the Bank of England had to specifically make coins just to trade with China. There weren't enough silver coins to go to China, so they had to make a coin called the silver dollar. The Bank of England actually made a dollar so it could trade with China. Lots of countries had to make these silver coins to satisfy demand in China. So it's a classic example of how there is one money when it's a metallic money, and people have faith in it. Clearly, if you are a country who had a reputation for not putting silver in your coins, they didn't trade at par with everybody else. They went to a discount. And if you were sitting in Edinburgh, I suspect in Lausanne in the 18th century, you would have had a great big list of the coins that were considered to be good and the coins that were considered to be slightly diluted. And the world ran on that system for a long time, but it has a problem. The obvious problem is who controls the supply of silver, and is the supply of silver going to grow at the right pace or not, too slow, too fast, but it's not really up to human beings. So the real, the thaler, the Great British Crown, the silver dollar. So it's 1964 when America last minted one of these. Now this one was made in actually 1996. This was a gift given to me in 1996 by the United States Treasurers Association. But the last one minted for circulation was 64 because that's when a dollar was pretty close to the price of silver. These are still minted today, and these are minted in commemoration. No one's going to spend this. I mean, I'm not going to buy anything for Jared for $1 and hand him a coin which is worth, I think it's $46 now actually, because it's not quite an ounce. As of today, there's $46 in this. But they still mint them as commemoratives. So you can still get them, but they haven't actually circulated. And it's difficult to foresee a time when they would circulate again. So 64, the US stops making those. It's 79 actually that Mexico stops making them. And so a silver dollar today, when I wrote this, and you can see on the piece of paper here, it says 34.5 an ounce. That was May. And it's now 50. So there's another problem with using precious metals in terms of the volatility of the price. So that's, as you probably know, we could do 6 hours on coins, but that is what I'm going to do in coins just at the minute. We'll come back to a few in a minute. So ledger money is important because it can happen without anybody seeing it. And I think this has been a problem for historians, that they didn't actually see it and didn't know it was going on. I've described earlier how it works, but you need a trusted record keeper for that. That's the most important thing. If the record keeper can't be trusted, it doesn't work. So if we look at the Italian example, you find quite often it's a charity. Everybody trusts the charity, so therefore the charity can keep the records. We don't think they're going to adulterate the records, but unfortunately it works more in small geographic areas. So now we get to money creation. So I want to just run through the mechanisms through this on the bank that I happen to know relatively well, which is the Bank of Scotland, which was formed in 1695. So this is how you form a bank in 1695. And we do this because it will explain how money is made today. So the shareholders raised the money, and then they rented a room in the Royal Mile of Edinburgh, if you know the Royal Mile. And they put behind the counter the assets of the company. The assets of the company were gold. So they raised cash, sold the cash, had the gold, put it behind the counter. Gold in any form, coins or bullion or whatever. And everybody in town knows they've got gold. And then what they started to do was to lend money. You didn't launch a bank by accepting deposits. These guys didn't accept deposits until 1710. So it was nearly 14 years before they accepted a single deposit. So here's how it works. The first person, it had to happen one day, somebody walked in and said, I'd like to borrow £10. And I wrote a piece of paper saying this is the entitlement to £10 worth of gold. And of course charged interest. Now the person walked on to the Royal Mile of Edinburgh with this piece of paper to buy a horse and cart for £10. And he had to find somebody who would take that. But of course, most people knew the gold was there. It was a receipt for the gold. And very quickly, people started taking these notes because they knew the gold was in the vault. After a while, something really interesting started to happen, which is where we are today. And that is the bank began to realize that people were not bringing the notes in and asking for the gold. And therefore, the temptation was just too much. And they began to create more notes than there was gold. Now, you remember, every time you create a note, you're charging interest, let's say 6%. This is incredibly profitable. This is called fractional reserve banking. And it's a tremendously good business. It's the business we still have today. And that is how money is made. The bankers make more money every time they make a loan. Now, you might say, well, we don't have gold in the vaults of the banks. We don't. I described earlier what the assets of these banks are. Well, the liquid assets are obviously cash and notes in the bank, but primarily the liquid asset today that would satisfy you if you came in would be reserves that the commercial bank owns with the central bank. So that's not gold, but that is effectively, if you think of the same mechanism, that is how it operates with the reserves replacing gold. Now, why is that so incredibly important? Whoever controls the banks is the monetary authority. That is something that we're missing in modern money understanding. There is some great mystery somehow that the central bank has to control money. But what happens if one morning you woke up and the banks were controlled by the government? The central bank would be impotent. It would be impotent. So what is the central bank supposed to do to control these banks? Because at the minute, the central banks are the monetary authority. Let's assume you're all the Swiss bankers here. One of you will be more important than the other, but you're all Swiss bankers. I'm the Swiss National Bank. What I try to do is to control the way you make money. And I do that through lots of mechanisms. Obviously, I can have interest rates. And if I put them up, I can slow the demand for credit, to make it more difficult for you to expand your balance sheet. I could demand that you have more capital. And if you have more capital, then it slows the pace at which you grow the balance sheet. I could maybe demand you have more liquidity to do the same thing. Or I could maybe change the risk weighting of your assets and trying to work out your capital adequacy. That's just 4 ways in which a central bank plus regulator, sometimes the same thing, sometimes separate, can control the pace at which commercial banks expand their balance sheets and create money. But during COVID, something very different happened, and that is the governments went to the banks and said, lend lots of money. And they did. And they created lots of money. And from 2020 to 2022, I'm just looking at the United States here, the supply of money went up. Sorry, I'm looking at the Eurozone. The supply of money goes up 20%. From 2009 to 2019, Europe had hardly created any money because it was the central bank that was trying to do it. The central bank was buying assets. The ECB was buying assets. The assets predominantly government bonds. And they were buying that money, they're buying those bonds from savings institutions, primarily in banks. And that money wasn't getting used by the public. So what I call narrow money, that reserve money was growing incredibly quickly. But the total supply of money wasn't growing quickly at all. And then suddenly, 2020, everything changed. For the first time, and I think it's for the first time in probably in human history, banks started expanding their balance sheets into the worst recession in history. The worst recession by speed, not by magnitude. The world is falling apart and banks are lending into it. Why? Because the government is telling them, we'll make sure you're okay. So in the next 2 years, the supply of euros goes up 20%. Guess how much broad money goes up? 20%. And with a bit of a lag, inflation goes up 20%. There is a very clear lesson from 2009 to current about how money is made, who makes it, and what the implications of that are. And anybody who can control that bank controls the supply of money. So you probably know one of the great debates in finance is Will the central bankers always remain independent? Will the governments change their targets? Well, they don't have to. If they can tell the banks to lend at a certain pace, then the central banks are redundant. So once we understand how money is made, we can get into the business of working out what happens next. Now, one of the things I haven't mentioned in these things is called credit controls. Credit controls were utilised particularly in Europe post-World War II. And it was when I, as the government, not the central bank, would go to you, the commercial bankers, and say, next year, your balance sheets are growing at 10%. Get on with it. That's it. So I, the government, am the monetary authority. And that's what we have to look forward to. That is what, if you like, saved a portion of the citizenry during COVID. And that is what is coming back. And in that world, you should expect more inflation. That is a world where the reason that this power was gradually taken away from governments and passed to central bankers is they tended to make too much money. And that is the world we're going back to. So are we there today? No, I don't think we are. I thought we were in 2020 because the commercial bankers were doing exactly what they were told. But the inflation that came was so terrifying for the governments that they handed the reins back to the central banker and said, you better sort this out. What a terrible mess, and it's all your fault. Well, if we get an economic shock, which I think we will very soon, then the governments will be back. And they'll have learnt their lesson from 20 to 22. It's not quantitative easing that solves this problem. It never was going to be quantitative easing that solves this problem. It's getting the commercial banks to lend more money. You might have to guarantee that credit. You might have to offer them lots of incentives. You might just have to force them. But that is what happens next, and that is why the future is one of inflation. So if you see anything at all happening in any economy in the world which tells you that the government's having more control over the commercial banking system, that is when you have to say, yes, the future will have more inflation, and we're not quite there yet. So that's most of the money in the world. So when they take control of the banks, remember, you don't have to own a bank to control it. You know, we go back to post-World War II. France, they owned the banks. It was quite easy to do this. But through the powers of regulation and taxation, you can control a bank without actually owning it. That's what they did during COVID. There were no nationalised banks during COVID, but the banks did exactly what they were told. I think I've covered bank deposits as modern money. Let's talk about inflation and money and how you create inflation in the modern economy. You'll see that famous quote from Milton Friedman, inflation is always and everywhere a monetary phenomenon. And in Friedman's world, it's really whether you accommodate a supply-side shock. So there'll be two oil shocks in the 70s. I think in terms of aggregate pricing, Friedman would argue that if you hadn't allowed the money supply to expand rapidly, your aggregate inflation level would have stayed pretty steady. In other words, the oil price still would have went up, but the whole of the economy would have collapsed and price of everything else would have come down. Unfortunately, fortunately, that is not the way the political economy works. The idea that you can get a supply-side shock like the oil shock, where the governments of the world say, oh, what the hell, let's just keep money supply growth at 4 or 5%. Let's take a 15% contraction in GDP, nominal terms. Let's move on. That is not the way it works. So what failed in the 1970s was the political economy, because they worked out quite rightly that this could not be accepted by the population, so they printed money into it. They printed through the banking system, they generated money, and they accommodated the oil price shocks, and we got much higher inflation. So to an economist, it doesn't have to be that way. To a political economist, it had to be that way, because the consequences of doing it any other way are dire, particularly today, because debt is so high. Now, a deflation, which is what you get if you do not accommodate that, the rest of the economy really contracting viciously. When debt is very high, it just gives you gross defaults. So from a political economy perspective, we can't do that. We're going to have to provide monetary accommodation. I think COVID shows you exactly that. Nobody, or very few countries, Switzerland was one of them actually, stood back and said, we're not doing anything here. We're not really getting the banks to lend more money. So that is the political economy of this. So you all know that money can be printed in the form of banknotes. I brought my $100 billion Zimbabwe banknote, but of course Boris outdid me because Boris has a $100 trillion Zimbabwe banknote. This one you'll be more familiar with from not far from here. That's the 5 million Weimar banknote, 1923. So you kind of, because of the history of this, you kind of think that that's what it's going to look like. But of course, it isn't going to look like that. Remember this stuff today, let's pick the Swiss one. This is, well, in any other economy, this is 3% of the total issue. I think it's higher in Switzerland because you have a 500 franc note, which tends to sort of, tends not to move around so much. Let's put it that way. So I think it's probably slightly higher than 3, but you're not going to inflate Switzerland by creating this stuff. Well, you are going to inflate Switzerland by creating more bank deposits, by lending more money. And that is exactly how it was done during COVID. The inflation that we've had post-COVID is not only with there being more banknotes in circulation. I think we know that there are actually probably fewer banknotes in circulation. It's because we drove up the supply of deposits. So printing will come in many different forms. I have a question in here about what the Weimar German inflation achieved. Well, arguably World War II. This is serious stuff. You know, the idea that this is something that you do in spreadsheets, that you can forecast the future simply by working from a spreadsheet, this led to World War II. It wiped out the middle classes of Germany. It made them looking for any answer, and any answer came in the form of Adolf Hitler and fascism. Money matters. It doesn't just matter to how much money you have, it matters for the stability of society. And if you want to wipe out a middle class in particular and leave it susceptible to that, then it takes you to, and it can take you to a very dark place. So this is important stuff. And the idea that this is all in a spreadsheet is kind of nuts. Imagine sitting around in 1924-25 when the market stabilized by a man whose book is here, Hajmar Schlacht, My First 76 Years. Amazingly, he never got a second 76 years, but anyway. Hajmar Horace Greeley Schlacht actually is his full name because he was born in America, Hitler's central banker. Imagine sitting there, Schlacht stabilizes the currency and say, oh, thank goodness for that. Everything in Germany is going to be okay now. But the legacy of the old and the destruction of the middle class lingered on. So when you're talking about money, there's many, many, many more things to forecast that where it is. It's the damage it's done, and the damage it's done to society, the damage it's done to the rule of law, the damage it's done to property rights. So going forward, as I said, money printing will be, well, how will we do it today? Well, the government could borrow directly from the banks and hand it to the citizens. That is, the balance sheet of the commercial banks expands. This is a direct loan to the government. The government takes the newly created deposits and it just gives them to the citizens. I think we got pretty close to that during COVID, so you can do that again. You don't have to print another one of these notes. You've achieved that. The government could borrow from the central bank and do that. That's another way of doing it. In fact, some of the great hyperinflations have simply been caused, including the Weimar Germany, by the government borrowing from the central bank. Central bank makes it money, hands it to the government, and they just hand it to the citizens. Unlike quantitative easing, where the central banks bought assets from financial institutions. Kind of got stuck in there somewhere. It didn't really get out so much into the public. But if you take the government, put the government in there instead, and print money and hand it to the government, it gets into the economy, you get the inflation. Or the government could create a new form of money that circulates. You probably remember Yanis Varoufakis was very keen on this as a way for Greece to get out of its problem. There would be two currencies, and apparently that wouldn't affect the exchange rate. So Mr. Varoufakis never got to put that into action, but you could create another currency that would also circulate. So these, if you're looking at a world of inflation, these are the things I think you have to look out for. What I would say at the minute is there's no sign of this happening. Now that's a hell of a big assertion. There is clearly signs of inflation. I think that's a legacy of the last money creation. But if I look at, well, I've just done this, I've just written the piece for clients. What is the growth rate in the lending of the German banking system to European residents? So euro lending by the German banks is, well, it's contracting at 1% year on year. Now you might say, well, that's the biggest banking system in Europe contracting. Well, you'd be wrong, because that's the second biggest banking system in Europe. When we look at what backs the euro, today, the biggest banking system in Europe is France. It is 31% of all the credit assets. Germany is 25%. You say, well, thank goodness the French bank system is lending. It isn't. It's not. Euro loans to euro area residents in France are up 1% year on year. Germany down 1% year on year. Now, both of those banking systems are fairly aggressively buying government bonds, but they're not lending to the people. In my world, where we create more money than inflation, you'd have to see a significant increase in bank credit and money creation before that would follow. 60% of all the money growth in Europe, and it's very meager money growth, is coming from the Netherlands, Ireland, and Spain, which make up, I think, 22% of GDP. So it's very unbalanced. You've got three economies that are doing pretty well in creating money, and the two biggest economies, making up 57% of the entire European banking system, are really struggling to lend money. That's not going to stay like that. At some stage, someone's going to have to change that, whether it's Mr. Merz or Mr. Macron or maybe somebody else. Time will tell. But at the minute, if you're trying to forecast whether we're going to go to inflation, I would say no, we're not. We will have to, but we're not going to. I think the interesting thing when we look at money and what backs it, which is bank assets, is to look at the change in the euro since its launch. So on launch, 41% of all of the bank assets, euro-denominated credit assets that back the currency, were from one country. That country was Germany. 41% of the total was German bank credit, effectively loans to the people of Germany. Today it's 25%. And France has gone up to 31%. This is a banking system that is really dominated by French credit. Now there's another problem. When the euro was launched, France and Germany, in terms of their debt, were really remarkably similar. And they were slightly different, but they were roughly about 210% of GDP. So you took the whole debt of France, which would be the government, the household sector, the non-financial corporate sector, divide by GDP, it's about 210% of GDP in 1999. Do the same for Germany, you get almost exactly the same number. Here's the problem today. Germany today is really relatively unchanged, and France isn't 210% of GDP, it's 322% of GDP. So you launch a single currency backed by the high quality credit assets of a German banking system, which is lending to a very undergeared society. You end up today where 31% of all of that money is lent to the world's second most highly geared major economy, which is France. You'll all know that Japan is number one at 380% of GDP. But French debt per head is significantly higher than Japan. So I'm not going to labour the point on France. You can watch a video here recorded about 18 months ago about the euro in France. But the euro is not backed by the same high quality assets it was backed by not that long ago. Maybe we can come back to that at the end, but I think one of the ways to deal with that is the way that Europe eventually dealt with both Greece and Cyprus. I happen to know, because I've just checked it, that the total debt of Cyprus when capital controls were imposed, so the IMF, the Troika was the IMF, the ECB and the European Commission. To solve the debt problem of Greece and the debt problem of Cyprus, they imposed exchange controls. If they were going to put a huge amount of public money in, they didn't want all that private money sneaking away and getting out. The peak level for Greece's total debt in US dollar terms is $550 billion US dollars, which was June 2015. Today, France's debt is 10.5 trillion US dollars. Within France, 53% of all government debt is owned by foreigners, 70% of all bank debt is owned by foreigners, and 60% of all non-financial corporate debt is owned by foreigners. These are the securities, not the bank debt, the securities. So foreigners have got this huge role in lending to France. So this is not a French problem. This is a global problem. And it is a big if because nobody believes me, but if they have to use the same techniques to stabilize France that they used to stabilize Greece and Cyprus, there's a stop on capital flows out of France. And based on the data, net international investment position data, foreigners have lent France 2.7 trillion US dollars. Capital controls are one of the things that comes along when you're inflating away debt or going to war. Now, one other thing is money can be and is created often by the private sector. I've mentioned these banks. In Scotland, the Royal Bank of Scotland gets a monopoly, 1696. for 21 years, and then anybody can open a bank. So any of us can simply get gold, put it behind the counter, and start issuing banknotes called free banking. And it's up to the market whether it accepts those banknotes or not. And that is a system Scotland used for a long time, and really very volatile, but pretty successful. Very few examples of people not getting paid back on their banknotes. But the private sector created a lot of money. Most spectacularly, a bank from about, I think it was 1768 to 1771, there was a bank called the Ayr Bank, that's A-Y-R. It's a town in Scotland. Within 3 years, it created 30% of all the banknotes in Scotland. So guess what happened next? Nobody lost any money on the banknotes. That bank was backed by the biggest landowners in Scotland. And the biggest landowners in Scotland made good on every single note. For some of them, it meant selling their estates. For some of them, it meant mortgaging their estates. But the banknote stood good despite the bankruptcy of the bank. So another example of credit backing the note. That's why everybody took the notes, because they knew the credit effectively of the shareholders was good. That was an unlimited liability institution. So we can still create money in that way. You'll know that in pre-revolutionary America, there were forms of money in the form of tobacco, and beaver pelts were used as money. Prisoners of war used cigarettes. There is a really good piece of research, you'll find it on the internet, by a prisoner of war in a German camp, looking at inflation when Red Cross parcels arrived with more cigarettes. And you could link pricing to the arrival of cigarettes, which were an effective currency. Cigarettes became a currency. In 1966 in Ireland, the banks closed for nearly 3 months. There were no ATMs. This is before ATMs. None of the banks were open. So what happened is checks became money. Once again, Boris wrote a check to me. I endorsed it to you. The checks circulated. Maybe 30 people endorsed on the back of it, mainly cleared through pubs. Pubs are the place in Ireland where everybody knows everybody else. Once again, I could look down the names of everybody who'd endorsed that check, see that they were all good. When the strike ends, in goes the check and it starts bouncing around and finally it clears at the end. People are very, very good at creating money. I've got another example here. This is what we would call a 2p coin. This is made of copper. So in the Napoleonic Wars, Britain doesn't have a lot of silver and gold. It's fighting a war. But prior to that, people were making these coins. Private sector, UK was making these coins because there weren't enough around. They were making their own copper coins and they circulated freely because they're called token coins. And a token coin is, not this particular one, but the other ones said on them that you can redeem it for silver. But they were issued by a mine, mainly issued by a mine in Wales. But everybody knew the guy who owned the mine was very wealthy. So they didn't mind accepting a piece of fairly worthless copper, or like half value copper, because they knew he was good for the money. So there is a private sector institution with good credit able to issue money. This one is actually issued officially, printed by a guy called Matthew Bolton, Bolton and Watt, under the auspices of the British government. So we have got lots of history of the private sector creating money when the government isn't very good at it, or where there is no government, such as in prisoner of war camps. In Ireland, we have something called gun money, created by James II during the Williamite Wars. James invaded Ireland to try and get the crown of the United Kingdom back, or Great Britain back. Didn't have a lot of money, so he issued money which would be redeemable after he'd conquered the country. So there would be a date on it, and it would say, you will be paid back by next February, because by next February I'm going to rule the whole country, and I think you probably know what happens with that. But that's another form of token money. But it's not token money that you can bring in and get silver for tomorrow morning. It's a promise to pay in the future after the country has been conquered. So we must never underestimate the ability of the private sector to generate money. So that's, I think, a brief run through money and peace. But then it helps you kind of understand how we create money in war as well. So this is how we fund the war. And depending on how you fund it, you can have radically different outcomes. So tax is the obvious way to do it. So if we go back to, say, the First World War, you find that a country like the United Kingdom relied quite heavily on tax. Germany relied quite heavily on printing. Now, as it happened, Germany lost the war anyway, but it had already printed much more. And you understand, having listened to this, and you know anyway intuitively that if you're going to print, you're going to get an inflation problem. So you can tax, you can borrow. The United Kingdom borrowed extensively, and there is an argument by Neil Ferguson and others that the secret of the United Kingdom in winning a series of wars through the 19th century was actually its ability to borrow. Its ability to borrow from the British public, very large scale, and they trusted the United Kingdom government to pay them back, which actually was a trust well worth betting in during the 19th century and a disastrous bet during the 20th century. So you can borrow, you can print, which we've discussed, and you can plunder. You can simply take the wealth of the nation you're going to invade. You can say, look, as I mentioned with the gun money, we'll pay you back after we've taken all the wealth from this country. And how a country going to war chooses between these has a radically different impact on, well, certainly on financial assets, which is something I know all of you are interested in, depending on which of these that you decide. So I thought I'd go through some of the more peculiar ones that we've had coming out of war. I mentioned this one, where if you run out of silver and you run out of gold, you simply can't import anything because there's a war coming over, but you have copper mines, you make that. That's 2 pence. So in the old system, to have £1, you needed 120 of those in your pocket. So you can see why, apart from warfare, it probably wasn't a very practical thing to do. This is known as the cartwheel penny, because our two pennies, because it's one of the biggest ones out there. This one, which I just bought in Belfast in a market, is Japanese military money. So another way of doing this is after you've invaded a country, is you confiscate, or at least you try to confiscate all the money. It's not difficult to get the bank deposits, because you walk into the bank with a rifle and you go and see the manager. That's not difficult to do that. However, this is from the what we now call Indonesia, Dutch East Indies. And when the Japanese, they did do that exactly to the banks, and they eventually demanded that you hand in all your guilders. This is a Japanese guilder. You don't expect to see Japan and guilder together. There's Japanese rupees, and the Japanese would put these in and try and get these passing off and get the hard currency back. It's illegal to use the hard currency. It doesn't stop people using it. Certainly doesn't stop people hoarding it. But illegal under military dictatorship has implications larger than a fight. So you can be quite successful at putting this stuff into circulation. And eventually, of course, it ends up worthless. My friend who's from Malaysia, his father remembers taking these around at the end of the war as a small boy in Malaysia who also had them. Bucket loads of them. And nobody would take them. So these, on the whole, this one slightly different, but a lot of them finished up completely worthless, but that's because Japan lost that particular war. Now, my favourite one is this one, which looks brand new, doesn't it? And there's a reason for that, because it is brand new. This is called the Marie-Thérèse Thaler. And I'm looking for the date. I think it's 1782. Anyway, I can't find the date, but I'm going to tell you it's 1782. So how did I just go to the mint in Vienna and buy a coin with 1782 on it? This is probably the most amazing story in the history of currency, because this thaler, which I'm sure you all know, it's another one of those 1 ounce silver coins. When Marie-Thérèse was on the throne, was widely accepted in the Horn of Africa, Ethiopia, Aden, and the Gulf, and it still is. Now, not as widely as it used to be, but once again, I had another friend whose father served with the British military in Aden in the 1950s, and these were circulating freely in the Horn of Africa because the people of the Horn of Africa decided this was good money. And everything that came after that maybe wasn't so good. And they're still minted in Vienna today. I gave a lecture in Vienna early this year. I bought 5 of these. I was in a pub with some academics. I bought the beer, and I put on the table, I put a €50 note, and I put one of these beside it. And I said to the barman, which would you prefer? And he said, I'll take the coin. And I said, well, why would you take the coin? Because you really don't know how much it's worth, do you? What if I told you it was €26? And it was €26 when I bought it. He said, I'll still take the coin. So I can tell you that Marie-Thérèse Thaler has been circulating since the mid-18th century and continues to circulate today in Vienna. But the reason for talking about this was because of warfare. So what role does this play in warfare, this silver coin? Because this coin was not just produced in Vienna. During the Second World War, it was also produced by the British and the Italians. Because if you're trying to pay people in the Horn of Africa, and the British were trying to pay people to fight the Italians, and the Italians were trying to pay people to fight the British, you had to have the currency. So they made these. And of course, they had to make them of silver because the people of the Horn of Africa are not stupid. So everybody started making these silver coins because that's what would pass for money in the Horn of Africa. 1780. So that 1780 is when she died. That was the last one that was made. So long after she's gone, they're still moving around the planet, and they're mainly worn as jewelry. So more a store of value and a means of transaction. But in a turbulent world, you can actually wear your wealth around your neck. And a lot of those ladies in the Horn of Africa getting a lot richer in the last 3 months. Some more wartime currency. So this, as you may or may not see from the back of the room, is a Bank of England £50 note. But this didn't come from the Bank of England. This came from Lake Triplets. I get the pronunciation correct. It comes from a lake near Salzburg. So what is Toplitz? What is a £50 note doing in a lake in Austria? Well, this was forged by the Germans at various concentration camps when their poor inmates, lots of Jewish inmates, were forced, because lots of Jewish people were very good at engraving, forced to make these notes. And initially the plan was when Germany invaded the United Kingdom, it would drop these from airplanes and destroy the monetary standard of the United Kingdom. Now, the Germans knew a lot about printing money and destroying, because they're concocting this plan in 1940, and 1923 they'd done that to their own currency. So they started producing these. Obviously they never did invade the United Kingdom, but they still managed to pass quite a few of these off. Where did they go? Well, mainly neutral countries, including Switzerland. Now, it wasn't often that a Swiss bank was fooled by one of these, but there were Swiss banks who did take these. Not many here. But actually, it was more like Portugal, Spain, Turkey. The Nazis would pay spies in particular. They'd pay them with the fake money. The fake money didn't really find its way to the United Kingdom until after the war, when the British Army discovered them and started sending them home, forcing the Bank of England to recall their banknotes. Possibly, no one knows for sure, that 10% of the entire money supply of United Kingdom may have been in the form of forged banknotes. Who knows? So many of them are at the bottom of the lake that perhaps we'll never know. Now, there's a famous spy in Turkey called Cicero. He's a Turkish man, spied for the Nazis. They paid him in these. And only after the war, when he went to redeem them, did he find out they were fake. So what did he do? He sued the German government. The Nazis have long gone, but he tried to sue the German government, saying, you promised to pay me all this money for spying. I spied, you paid me with this. And needless to say, he didn't win that legal case, but he actually took many, many years of petitioning to try to get Germany to pay back. What is the point of all of this? It's said that the first casualty of war is the truth. That can't be true anymore, because there is no truth anymore anyway. I mean, you're telling me that we're only going to start lying when the first bullet flies. We started lying years in advance of that. This is not a good sign. The first casualty of war is price stability, and it's the monetary standard. And whether that means leaving a gold standard, getting your banks to lend more money to the government, creating fake notes, the first casualty of war today will be price stability. So if that is where we're headed, you can bet on higher inflation. And I can't think of a war where that didn't happen. The demand for commodities alone in warfare is so high that it tends to send inflation up. So it's not just the currency of the loser that goes to zero. The currency of the victor can go to zero. So particularly America, the continental currency, eventually redeemed at 1 cent on the dollar, because they didn't have the wherewithal to make good on it. So you can actually win a war and still lose lots of money. Which reminds me of that great line in Catch-22, where the young, enthusiastic bombardier is talking to an old Italian, explaining why he's fighting to win the war. And the old Italian asks, well, why don't you lose the war? Because that way you get to default on all your debts. You really don't want to win a war. You would do it the Italian way, make sure you lose wars and wipe out all your liabilities. So undermining the circulating medium is one way of doing it. I make a note here that the British were doing this in 1776. They had a ship lying off America that was printing these continentals. So it's not a new thing to think that you can do that. So what am I going to finish on? I'm going to finish on who controls the money supply. Well, today we think it's the central banks by controlling the commercial banks. but that can change in peacetime. I argue it changed during COVID. It will certainly change during wartime. The first casualty of war will be the money supply and price stability. And then who wins the war? Well, who wins the war is not just about who can put the most military equipment or personnel in the field. It has been historically who can borrow the most money. And it would help if you started with a low debt to GDP ratio as opposed to a high debt to GDP ratio, if that is the direction of travel. So none of that is me forecasting war, I hasten to add. But that last page will show you the debt to GDP ratio of America. This is the whole of America. Government plus household sector plus private sector going back to the Second World War. And what you will see is we are at an all-time high and well above where we were during World War II. And America has got one of the lowest levels of debt to GDP in the world. It's only 250% of GDP. Most countries are higher than 250% of GDP. I've mentioned France at 322, Japan at 380, but other countries like Canada, Australia, Switzerland has actually now got a very high level as well, particularly in the household sector for reasons that you all understand. If we flip this the other way around and say, look at a thing called the private sector debt service ratio. So this is a stock debt relative to a accountancy flow, GDP. If we look at a flow against a flow, so the flow against the flow is you look at the entire private sector income of Switzerland. And you look at the percentage of Switzerland's entire private sector income needed to service debt. So that's interest expense and a little bit of amortization. It's at 21%. It's never been like this before in Swiss history. There's just never been this level of gearing in the private sector. Now we all know the government has got quite a low level of gearing, but the Swiss private sector has got a very high level of gearing. So wherever we're going there with very high debt. So in the long run, not the short run, but in the long run, you can bet on higher inflation because it really is the only way that we can cope with this. And I would say you can bet on it in Switzerland, which is the controversial bit, that this is not your father's Switzerland. The debt levels are much, much higher in the private sector. The government has this one great big bank it has to look after. And I think despite the amount of money pouring into Switzerland, despite the upward pressure on the exchange rate, I'm not so sure that the Swiss franc will have the role going forward that it has in the past because of the debt in the private sector.